Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel here on YouTube, where I help you make your dreams a reality. It is the witching hour in our house. Who knows what the hairless cats are up to? Hopefully, they're bedded down. Um, we're anticipating rain and more cold, so hopefully they're bedded down, but anything's possible. Uh, we are talking closed-end funds this video. But it's just one component of the whole system. So if you want the whole financial freedom system, then head to Facebook, where I talk daily about 12 steps to financial freedom and a host of other things, really just a long ongoing list of other things that get you from where you are to where you want to be. Reminders, it is an unedited video. Who knows what you'll hear in the background as I film these in my house. This is not perfect video. This is not edited video. This is raw, unfiltered. I make mistakes video because I like it, because it's authentic. Um, I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. Our self-managed closed-end fund portfolio is built on lasting dividends, not the gradual sell-off of own funds, which is very different from most advisors these days. And that means the day-to-day, week-to-week pricing doesn't bother me. It doesn't weigh on me. Now, it gets my attention, but it doesn't drag me down. I've gone over the whole complete strategy on the last several videos, maybe the last 4 to 6 weeks. The shorter version is that we play the long game. I watch the investment talk shows when they're notable, but I don't watch those guys because they all say the same thing. They all hit the same circuits. They all think they know what they're doing, and the vast majority don't. And even if they talk about closed-end funds, outside of one group who is not on those talk shows, outside of one group, no one's evaluating closed-end funds as a closed-end fund. They try to compare it to stocks or mutual funds, and it's a very different thing. It's like comparing apples to oranges. Uh, those talk show guys still talk about the 60/40 stock to bond portfolio, but honestly, that thing is dead. Um, that is not going to help you in today's market. The 4% rule, where you've got a million invested, and let's be honest, do you have a million invested? But on that $1 million investment plan, where $1 million is your principal, the 4% rule is you're taking 4% out, hoping the market gains 4% back. That hasn't happened recently. Now, let's say you have a million invested. When you retire, what's your salary? If it's more than 40 grand, then you'll be taking out more than 4%. Because 4% of a million is 40 grand. You're taking that out, whether the market's high or low. You're hoping the market put backs at 4% or more, and that's not happening either. So if your retirement salary, if the last salary before you retired was 80 grand, you're taking out 8%. If it's you and your spouse, you're taking out 16%. You factor in inflation, that's 4%, and the market has not been performing well. So now you're out of your retirement way early. Not helpful. So if the old guard strategy is dead, and it is, because the guy who invented the 4% rule admitted it doesn't work. So if that doesn't work, what's the alternative? Uh, we've we've created, our system is a no withdrawal portfolio that's designed to reap dividends instead of the slow cash outs, so that our principal stays intact and grows, and we get dividends. And the best way we found to do that is through closed-end funds. So how are we doing that? We created a filtration system in that you never pay a premium and you always buy on discount. Now, you never pay a premium. How serious is that? You never pay premium. We target crazy discounts, like crazy discounts, and we use historical data to improve our outcomes. Of the 422 closed-end funds, at least three-fourths of the, excuse me, three-fourths of those are currently on discount. So you've got to be able to separate the discounts from the discounts. Who's got better discounts and what does it all mean? Um, we target dividends and not 4% dividends, because 4% dividend minus 4% inflation is a break-even problem. We target 9% plus dividends and not the 0.5% crap you get with Apple. So we take Warren Buffett's advice, which is you buy stocks for 66 cents instead of $1. Now that sounds crazy because that doesn't happen in single stock entities. It does happen in closed-end funds. If you buy a closed-end fund for 34% off, you're really getting that for 66 cents on the dollar, which is what Warren Buffett's talking about. And then you take Rothschild's advice, or which I've heard attributed to a Rothschild, so that's what I'm going to keep doing until somebody points it out otherwise. When there's blood in the streets, you buy, even if it's your own blood. We buy in fear. That CNN greed meter is pretty accurate in that when everybody's screaming into the market and it's on like max out greed, you want to buy the discount, the best you can get. But you also don't want to go all in then. You want to wait till it ticks all the way back down to fear and extreme fear when prices drop and all those green investors bail out because they're afraid their money's losing, right? When that happens, then you buy. So let's look at the market at large. Let's talk about the market at large. The Fed has stalled rates, and almost everybody's predicting at least one rate cut sometime soon. Now, maybe before summer, maybe right after summer. Me, I think before summer. The green investors and the 60/40 stock advisors are waiting on the Fed to cut rates, like hyped up, jumping up and down, boxer ready to go, ready, waiting in the ranks. And I think they're going to keep waiting. I know I know the Fed comes out with another decision at the end of the month, maybe beginning of next month. I think they keep it the same, which will still drive down rates, which is good. But at the same time, that first rate cut, it is going to be an all-out battle. I still think we're headed for a recession. When the Fed printed $4 trillion in a very short amount of time and had the gall to lie to everybody and say, man, we just didn't see that coming. No shit. Y'all are in charge of money. Like, no shit. My 13-year-old can figure this out with supply and demand. When you print $4 trillion in a really short amount of time, you drive down the value of the dollar. You devalue the dollar. Inflation this, inflation that. You made our money worth less. And now it's the same group fixing the problem. So they have ways to pull money out of the market. And when the Fed tinkers with things this severely, we're going to see some kind of recession. The talk show circle guys are going, oh no, no recession in sight. And the undercurrent is that we're headed toward a recession. Now, how bad? I think it depends on a couple factors. The only group I've really seen predict the recession is the Contrarian Outlook group, which is part of the reason why I continue to pay for their services. But the other person who I've seen recently predict a recession is Jamie Dimon of JP Morgan. You've got him predicting a pretty bleak recession. And I think it comes down, I mean, there's tons of facets, tons of angles. You could say a lot of different things. I really think it comes down to who occupies the main seat of power. If the current, no, I'll say if Biden occupies that seat of power, then it will be as bleak as Jamie Dimon says it is. Maybe like a return of the 70s, like up and down inflation, craziness. And if Trump returns, then the Fed will still have some explaining to do. But I think the overall economic outlook on this country significantly reverses And we probably still have a recession, but I don't think it'll be as near as dire as if somebody else is not even leading the charge, just like there for the event. Um, so with all that in mind, regardless of who's in power and not, regardless of who's leading or not, you have to structure your portfolio where it looks in the future. You can't just structure it for tomorrow. You can't just structure it for next week, and you can't just structure it for who you hope will win the November election. So 10 years, 20 years, 30 years down the road, what are we going to buy today? And where is the market overall headed? So if I were investing on Monday, where would I park money? I think bonds are still an idea if you can find them on discount, which in a closed-end fund scenario, you can. They were the standout, and they've been the standout for at least the past 6 to 9 months. But 3 weeks ago, you have Bloomberg going, "Oh my gosh, bonds are amazing," and then everybody's bond prices went up. Go figure. Uh, if you're already there, if you're already invested, I would say enjoy the ride. And unless you can find more to scoop at a discount, but there's no point paying break-even pricing or premium pricing on bonds, really on anything, but especially on bonds. Where else would I put money? Energy infrastructure, anything energy infrastructure. Um, you have oil, utilities, energy transfer, uh, LNG, liquid natural gas, uh, the technology involved with all of that, like cloud data, cloud management, not outright technology, not the semiconductor component, not the computer part, although you could make a case for that, but just the ability to control the process wrapped up in, so like not NVIDIA, not the computer chip, but the software and cloud software with as advanced as we are technologically. Somebody's got to be able to house, control, and monitor, and then, keep safe all of that financial data that is somewhere on the overall World Wide Web. Um, and then as for what else, it's really anything else outside of outright technology. So like cloud tech, communications, digital management, digital interfacing, yes. Semiconductors and computers, like you need it, but at the same time, it's not as uh, at the forefront of my list as opposed to like cloud tech and AI and software management. Um, and then the other is just an outright consumer, which would be like a computer product. This laptop is a consumer product. The technology that goes into this laptop is not quite the same thing as the laptop itself. The technology to police the laptop, yes. The laptop itself, no. And I mean, it sounds like I'm splitting hairs, but it's really what it comes down to. So, knowing that, let's check out the bargains for the week. And for us, there is a very clear-cut winner. So this is our closed-end fund master. And it says membership because my goal is at one point to make this a membership access to where you see every single thing that I see. Uh, yeah, you get all the filters, not just what I show on videos. Or I guess you get everything unfiltered, not just what I show on video. So if we take this list and we scale it down to discounts, normally I rank them. Uh, so the buy alerts are funds that are at least double the historical average and greater than the last 5 year average. If the fund is 3 years old, then 3, 4, 5 years old, then it's greater than that average. Generally, with closed-end funds, they start at a great discount that gradually narrows, and then they kind of streamline, like it filters out from there. So you're taking a fund that has this really wide discount and then expecting it to even double, not not going to happen on a reality scale. So uh, double asterisk is a dollar cost alert. So something we own that is below its original price, which I don't think that is anymore. Uh, and then tracking, we just, so purple is recommended, olive we track in general, blue we own. Uh, and we just track funds. Now, when it's like this, it's honestly pretty confusing because all of these funds from here up are on some type of buy alert. And I can make the case for all. Now, we don't want to buy anything new. To buy anything new, it's got to be amazing. And I can make the case for one. And I might make the case for one. But everything else on here, um, a lot of it's consumer, a lot of it's consumer, consumer, consumer. We already have corporate bonds. Uh, some of these are municipal bonds. Uh, but that's a lot of funds. So normally I copy all this out and paste it on another tab like here. And I filter through based on yield. And then we look at overall. So we filter out based on what the company has inside. So the parameters, like so bonds on discount, energy, energy infrastructure. So energy, utility, energy transfer, oil, LNG, etc. Anything not outright tech, anything not outright consumer. You filter all that stuff out. Then we rank it on yield, and the goal has been 9% or more paid monthly. HFRO just cut their dividend in half, so it used to be 12%. HLB just dropped theirs 4/1000, so it used to be 0.084. And our goal, I mean, it's not going to make the list, but our goal has been 9% or greater. And I get the whole quote, like, buy when there's blood in the street, even if it's your own blood. And that's that fun. I mean, if we scale it back to all the funds, right? HFRO sits third on the overall discount list. You can track where it's been 33%. It narrowed 840 with like a 10% close in discount. Oops, haven't got there yet. There we are. Right. And then it dropped when they cut the dividend. It came back a little bit, but they've been restructuring. It used to be still private loans and bonds. And ahead of I've not seen anything from the company, not an email, not anybody else's review. So all I can see is from the outside looking in, is that they are restructuring their company in advance of where they think the market will go. So it used to be private loans and bonds, and now it's private senior loans and real estate. And they cut the dividend because what they were getting for the bonds and whatever they sold could no longer cover the dividend. So you cut the dividend, restructure the portfolio. And between HFRO and HLB, they do a great job managing funds. They're led well, they're structured well. So I can only hope that the dividend will return to 9% or greater. So if you buy it now and the dividend comes back and then the price escalates, then great. Um, and on my end, it's been 9% or more, but that would be the one that would uh, test that resolve because I do think that yield will come back. And I can get it pretty cheap now compared to where we stand overall. And I know that because I keep track of all that stuff. Current average price across all buys, almost $9. Current price under 750. It's a steal compared to it's a steal compared to our overall portfolio, but it's a steal compared to where it was. Let's see. Today's video, 1, 2, 3, 4 back, 779. So it's still what, 6 weeks ago, almost 850. So for sure a steal. Uh, but so if I rank it by target, the whole point of this, if I rank it by target, it looks confusing. Like there's so much there, but we weed out what doesn't hit the parameters. We scale it by yield, right? And you're really left with only a few, but it makes a lot more sense this week if we look at it like this. So annual yield, not what we're looking for. We have some category threes, but I'm not looking for another one. Besides the largest allocations on this guy, it's a portfolio in a can. You get a lot of different stuff inside one vehicle, but I'm not into a lot of consumer stuff. Um, it's too volatile, especially when you add in a world perspective, like world market. Um, let's see, Mexico-based annual, not an option. TEF, I'll get to. BlackRock, really don't want to be associated with categories, annual, BlackRock. I have some notes over here. Like the discount window is pretty much always the same. It rises. It really doesn't change off of around 14, but then you get semi, quarterly, semi. We already own the sister version of this in GLO. That's above price. It's just taken off. So we're just holding it. Um, I mean, it's tracking based on what somebody suggested, but at the same time, it's under its discount. It's not over. This one we own. Not really looking to add more of this particular fund. Uh, yeah, so if we focus on the top, that leaves us with that minus the gray one. We come over here, paste that. Current just means what we currently own. I always like to look at what we currently own. That is not what I wanted. Um, so consumer, not an interest. Annual payment, not an interest. Those are the top three. Uh, I can argue for this one based on its history, who it's managed by, and where I think it'll go. I can argue for this one. Generally, in a recession, factories cut production, which would impact their solar, and it would impact the industrial component of their portfolio. But it's also bolstered by utility and energy and bonds, and it's bonds on a discount. I mean, that's a significant discount overall. The caveat to this is that's a new company. Closed-end fund, me included, closed-end fund investors are very wary of new companies, uh, very leery of new companies. This one's not been around that long. It was restructured off of something else by Tortoise, and it's just a kind of continual downward slope. Um, if we have a true recession and production's cut, that's going to impact oil. It's also going to impact other parts of their portfolio. But as much as people predict that, there's a needed supply that the country needs along with the rest of the world needs. So we're not exactly operating on an excess level at the moment. If you look at the macroeconomics of things, maybe there'll be some cuts in the overall recession of things where things just cost more. But at the same time, I have a hard time. It's not to say Jamie Dimon doesn't know what he's talking about, but I have a hard time seeing that bleak of a recession for everybody. Um, maybe it is. If it is, then we all have some pretty interesting times coming. But I can be hopeful that it won't be that way. But if that's true, then really nothing is a great opportunity to completely go all in on anything. This is what we have at the moment. Um, pending we don't sell some funds. And if we sold those funds, I wouldn't go all in on what, uh, like I wouldn't put all of the money into a single fund. I would still spread it out. And that's not diversification because of fear of risk. Uh, that's another Buffett thing. Like diversification is really just uh, it's like an incompetent investment, but also a not, it's not confident in that diversification for the sense where you just have to diversify, like you don't know what you're doing, isn't the way to invest. And that's not to the point where I would say, you've got $1 million, buy everything in one company, uh, put everything into one closed-end fund. I would still invest it into specific sectors of the market, but I'm not going to invest in every single sector. I'm not going to invest in every single portfolio when I can, just because I'm afraid of how the market's going to do overall. Uh, all of these I could make arguments for. HFRO doesn't meet our current standard because it's not a 9% dividend, but it's still a great buy because that's a really great price and it's going to come back. Portfolio restructuring, I completely get why they dropped the dividend. It's managed well. The dividend will come back. Um, Sister company, lower dividend, still meets the threshold. Prices dipped a little bit, but it's also roared back. This is a new fund, and I have not seen a fund structured or managed this way. And they look at, and what I honestly, what me personally, what I hate about it is that it gets into that whole social equity and um, it's all based on sustainable and social impact, but there's a lot of social equity and UN standard worked into the company. And it has to be because of how it's organized. And I'm not a fan of that. But what challenges me is how it's structured. I've not really seen a giant solar investment through any other closed-end fund. And it's structured decently. It's new. It doesn't have a lot of money behind it. The company as a whole has a ton of money behind it, but they actually do consider solar. Now the difference is, I think rural solar is a great option because it keeps you off grid. I think urban solar just makes you a satellite power company because unless it's routed correctly into your own existing power structure, you're just, you're covering the back of your whatever wall, whatever section of your roof with solar panels and putting all of that company back to the power company. Um, I mean, like if people want to go solar, let them go solar, but don't make them go solar. So it presents an interesting caveat, or at least an interesting alternative to the energy market. And it's tempting in that regard, but it goes back to uh, overall belief system and uh, overall, you've had to explain this, overall comfort zone. Like I don't want to be tied to BlackRock in any way. And I really don't want to be tied to the UN in any way because I don't, uh, we'll say, I think, we'll just say, I think that's not the greatest organization ever. It's about the nicest way to say that. Kindest, maybe the kindest way to say that. Um, so as interesting as I think that is, um, I got to take it off because it just doesn't align with me. Um, the other part of that is solar comes from oil. So if you're going for a company that's targeting the energy market, um, and who's also trying to do it outside of oil, everything in their portfolio is really just tied to oil. They're just not saying it is. Um, go back. So utility companies, energy companies, industrial companies all need oil in order to function. Now, some of that is like there's a power company that is a nuclear power company. They're still dependent on oil to a degree. Solar panels are made from oil or an oil byproduct. So to be so sold out that you hate oil and want to do it a different way, your company still relies on oil. And it's kind of like, why not just invest in oil and not all the other stuff? It's kind of like the reverse of what I was arguing before. You could invest in all the, maybe the same argument I was making before, everything associated with your laptop outside of maybe the, if you've got gold inside your laptop, all the different particulars of your laptop, plastic, the electronics, the cables inside, the circuit boards, those video chips, all of that is an oil byproduct. So you can buy the laptop or you could just buy oil. Um, if you cut oil, you impact refrigerator production and shoe production and laptop production and pacemaker production and MRI components and crutch components and uh, the stain for this and the metal for that and the wood sealer for this and paint. Oil goes into so much more than you realize. So for your company to say, we're not going to invest in oil and we're going to invest in all this other stuff, that's just pulling the wool over people's eyes, just like you would an electric car. We're buying this because it's solar power, or it's we're buying this because it's getting power from the power company, which needs oil in order to run. So, um, yeah, I'll just take it off the list. So maybe that's me digging myself a hole with a larger than normal shovel. Maybe not. Um, but that really leaves just two companies on the list. So I could buy the company that's had a really significant dividend cut and doesn't meet the yield parameters, or I could buy their sister company that meets the yield parameters and will still come back with a raging, roaring dividend as the market upturns because they're invested similarly than TEEF, except instead of going no oil, everything else, real estate, energy, oil-based, energy transfer, utilities, still bonds, and bonds on a discount, that's a good deal. And that's a good deal. So I could argue for both. Um, if it's us, and what helps me is this is what we have currently. So what's been my thought process for a while is doing this. And that leaves me with a little residual. And then when we sell those other companies, then I have a little residual to add to the other stuff. And then we'll just carry that money forward and buy the next round. So where does that leave you? I honestly don't know. I don't know what you have and what you don't have. You don't have a closed-end fund. This is, go back to the overall list, uh, not annually, right? That's the top of the list. And that discount window will close. If that goes up, I mean, gosh, that could close by half. That they could actually close the discount by half, and it would still be an amazing discount. And they've tried, and the price has gone up, the discount has narrowed, and then something crazy in the market happens. So it's not that they can't do it. It's just you gotta find the right perfect storm. So if it's us buying tomorrow, this is what we do. We would pick up the 50 shares here and let it go. Because yeah, our goal it's been find a 9% yield that pays monthly and that can continue. I mean, yeah, they cut it a little bit and it's still beyond 9%. Um, if we sell some other funds or put more money in, and it's kind of a tie between everything, then I can argue about this one. But for you, if you don't have a closed-end fund, both of these are great options. Um, you just need to know your strategy. This is our strategy. What's your strategy? Is it a threshold on yield? Is it a threshold on discounts? Is it discounts related to the overall historical averages? Is it price? I mean, I could make a case for both. I mean, we buy this, we have more money left over and carry forward. Um, I mean, it's about half. So you just need to know your strategy and then stick to it and your belief system and stick to it. Like if you don't want to identify and you don't want to own some, you don't want to identify with a company and you don't want to own certain products that alienate the core of your beliefs, then stick with those because yes, it is money, but at the same time, you want to stay true to you. Um, yeah, I'll leave it there. So those are my picks. If you're new to the market, if you're new to the closed-end world, this is a great buy. And for us, honestly, it's a great buy too. It just doesn't meet our 9% threshold. This meets our 9% threshold. It's got a great yield. It has had a dividend cut, but they will come back. It's structured well for the current market and what everybody hopes is the coming market. But even if the coming market never comes, it's still structured well for the existing market. Um, and if it never changed, that'd be crazy. But going forward 10, 20 years down the road, our goal is to hold these funds indefinitely and not sell them. Uh, it, some of these are marked lifetime, like beyond my lifetime, somebody would sell them. Others are marked long term. Others are marked sell. Um, yeah, others are marked for different purposes. Um, pending performance, who knows? In pending market, maybe we'll end up converting these into a lifetime hold. But time will tell. So, but these are my picks. And really just this is my pick for what we would buy on Monday. So if you like the content, if you like me rambling, if you don't like me rambling, but you understand what I'm talking about, then by all means, please like the video, consider subscribing to my channel, hit the like button, and then head over to Facebook and check out my group there called Navigate Your Finances. And all that information will be below in the description. So wherever you're headed, you and you alone, you are the captain of your ship. Wherever you steer it, that's where it will go. So if you have no idea where you're going, you need to find out. And if you have no idea what that means, then go check out Navigate Your Finances. If you know where you're going, right, that's great because you know where you are and you know where you want to be. But your ship will go wherever you steer it. So make sure you know where you're going so you don't waste time on your travels. Um, the journey itself, whether financial freedom or whatever it is you're seeking, it's not going to happen on its own because if it could have happened on its own, it would have happened on its own. But guess what? It hasn't happened on its own. So you must make it happen. The outcome you want, you must work for. We're all where we are. We're all hoping for specific outcomes. In order to make those outcomes a reality, you must change and improve your response. You must make it happen. So go do the work. Just like Tim Kite says, we're here. This is where we want to be, right? The only thing between those two things is you. So go do the work. Make it happen. This is Daniel Young signing out. I will see y'all on another video. Bye bye.